Hello everyone, welcome back to HTX Live. I'm your host. My name is Royce, and today we'll be delving into a very timely topic. Is the global liquidity cycle turning? US stock rate cuts expectation and the second half of the crypto market. Before we officially start, a quick reminder for everyone in the live stream room. We will have a job during today's session. Make sure you stay until end. Stay activity in the chat and follow the instruction from our team. We will announce the participant details during the live stream and don't miss it. Today's discussion will focus on several key questions. Whether the Fed rate cut timeline is being repaired, whether the AI trade still has momentum, what DTC tokenization move means for crypto, and how institutional players may reshape market liquidity, and where the biggest opportunity may appear in the second half of 2026. Now, let's welcome our guest. First, we have Luis Diaz, CTO from B18. Welcome.
Yeah, hello everyone.
Okay, thank you. And we also have Wala from X-Stable community. Wala, welcome.
Hello, everyone. I'm really happy to be here. My name's Vera, and I'm from X-Stable. I'm currently focused on the community and ecosystem growth.
Thank you, Vera. Before we jump into the main discussion, could each of you give our audience a brief introduction and share what's your current watch most closely in the market? Luis Diaz, can you begin from you?
Yes. So I need to represent myself, right?
Yeah. Representation.
Yeah, I'm the CTO of B18. So we work on B18 platform and base together. UCard also. So we will discuss today different questions, and I'm very excited to begin this discussion.
Thank you. Wala, introduce yourself. Thank you.
Okay. As I introduced before, I'm focused on the community and ecosystem growth at X-Stable. And X-Stable is building the on-chain global macro exchange for Asia, Africa, and Latin America. So we bring the gold, FX, and real-world assets on-chain, and giving the user in emerging markets access to the same financial tools traditionally reserved for institutions. So our main focus is to build the financial infrastructure that enables billions of people to hedge inflation, manage currency risks, and participate in global capital markets directly on chain. We are incubated and backed by Solana, and since launch in December last year, we have reached over 100 million in daily trading volume within the thousands of traders across Asia and South America. So happy to see you all today and really excited to be here and join the discussion. Thank you.
Thank you. Sounds interesting. Now let's start with the macro picture. In the current environment, the Federal Reserve has been slow to cut rates. At the same time, U.S. equity and crypto assets have both shown strong momentum. Last Friday, no fund parallel come in much stronger than expected. The U.S. employment and economic data continue to beat forecast. So my first question is, do we think the market is already starting to reprice the Feder's rate cut timeline? And under this macro background, can US stocks and crypto assets still push to new highs? From Wella, okay, let's start from you.
Okay, yeah. That's a great question. So what I think this circle is a little bit different from 2021. And we back in 2021, the logic was pretty simple. And Fed prints money, the dollar weakens, the risk assets goes up, and Bitcoin outperforms as digital gold. So the correlations between the crypto and the Fed balance sheets was highly tied back to them. But if you look at the the BlackRock's Bitcoin ETF for now, it's been seeing that inflows almost like every week, and regardless what's happening with the rates. So that started to look more like a structural allocation decisions, not a wait for the rate cut signal trade. And I think there has another numbers worth paying attention to. That stablecoin market cap is now over 320 billions, and the neuro settlement volume in 2025 has already exceeded Visas. So that is a real cross-border payment, cooperate treasury flows, and the store of value demand in emerging markets. And like, to be honest, I think the last part is something we see directly in our own user base, and the demand from the Asian and Latin American to access the dollar assets on change doesn't pose because the Fed delays the cut by a few months. So yeah, there will be some turbulence and repricing around the rates expectation as for real. But if on-chain business activity keep growing and institutional flows keep coming in, I think the rate cards increasingly looks like a tailwind, not a premium driver. Yeah, that's my take. Thank you.
Thank you. Luis, what's your opinion?
Yeah, hello everyone once again. So yeah, last Friday's non-farm payrolls report came in far above expectations, while the unemployment rate remains steady at 4.3%. This effectively poured cold water on market expectations for emission rate cuts, and major institutions such as Goldman Sachs have even pushed their forecast for rate cuts back to 2027, and the market is increasingly pricing in a dramatic scenario of no rate cuts this year and possibly even further hikes. In this high for longer interest rate environment, can US equities and crypto assets still reach new heights? My answer is yes, but the driving force has changed. I hope you understand. We're living behind the era in which bad news was good news because it triggered monetary easing, and we're entering a new phase where good news is good news. Yes, so that's more positive, driven by earnings growth. So strong employment data confirms that U.S. economy is not in recession. As long as AI leaders and major technology companies continue delivering genuine EPS growth, EPS is earning per share. The stock market can withstand benchmark rates above 3.5% and grind its way to new highs despite volatility. This is fundamentally an earning driven story, so everything is fine. For the crypto market, we have news that Bitcoin has recently recovered toward the 60,000 level, 60,000 USD, reflecting the market's painful repricing of liquidity conditions. Without broad-based monetary easing providing abundant liquidity, the crypto market is entering a period of intense competition for exciting capital. So stop obsessing over the Fed's rate cut timeline. In the second half of the year, US equities will be judged by real technological productivity and earning growth. Bitcoin will depend on the expansion of complement investment channels such as continued ETF inflows. So, as I already said, volatility and divergence will dominate the landscape, but that does not prevent core high-quality assets from eventually breaking through to new all-time highs. That's all.
Okay, thank you. Sounds interesting. Now let's move to the AI trade. Over the past 6 months, AI-related stocks have driven a broad rally across global risk asset. But recently, we also see much volatility in TC stocks with sharper pullbacks across the sector. So the question is the AI bull market entering the second phase, or are we seeing the early signs of bubble starting to track? And more importantly, for investment, is this a risk-off signal or simply a health correlation with long-term AI-driven bull cycle? This question will begin from Royce. Can you give your opinion?
Yeah, sure. So recently, volatility in technology stocks has increased sharply. AI-related equities that once seemed unstoppable have experienced significant pullbacks, and comparisons to the dot-com bubble have resurfaced. My view is different, totally different. This is not a bubble bursting. It's a necessary transition from phase one to phase two of the AI bull market, a process of removing excess speculation and shifting gears. Phase one, the infrastructure and hardware boom. The defining characteristic of the first phase was simple. If you saw the peaks and troughs, the market rewarded you with virtually unlimited valuations. However, as computing infrastructure reaches a more mature stage, investors are now asking practical business questions, such as where are the applications? Where is the ROI? The recent correction reflects the fact that software and application law and monetization has not yet caught up with the explosive growth in AI infrastructure spending. And phase two, application explosion and industry penetration. The market is becoming far more selective. Investors are no longer willing to pay premium valuations for PowerPoint presentation and future promises alone. Blah, 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 right? In the second half of the year, capital is likely to flow aggressively into two categories. Companies that can use AI to generate measurable cost reductions and efficiency gains in vertical industries such as finance and healthcare. And number two, AI native companies building high mode killer applications. The current correction is therefore not an ending, but a healthy cleansing process separates genuine AI leaders from speculative imitators, right? For long-term investors, this may represent an ideal opportunity to accumulate high-quality core assets. Thank you.
Thank you. I agree with you. Well, what do you think of it?
Thank you for the questions. And Louis, that's a like amazing point, and I'm totally agree with that because I think the first phase of the AI market was essentially a repricing of the expectations, and the markets were pricing in a narrative that AI would re rewrite every industry and improve the efficiency. So that kind of the pricing doesn't anchor to any current earning. So it's like goes up very fast and constant fast too. And that's I agree with the Louis on the second phase. The questions gets more specific, like Louis said, the ROI, the business module, like whose business module actually works, and where does those AI profits actually land? We are seeing right now that the market is running that filter and squeezing out the pure narrative players and keep the one that can be actually generate the earnings. So it might be uncomfortable for the market, but it's really a normal situations. And like on the top of that, I think there's a very interesting point is the intersection of the AI and on-chain infrastructure. And this space is actually moving super fast. Like for example, the Coinbase X 402 protocol is already in the productions. And agentic wallets are a real category right now. So as they may suggest, AI agents already, I can say, like manage around 30% of total volume in the top DeFi tours. So the infrastructure for AI agents in crypto is getting the build and is like running fast and fast. But there has a one thing I might notice in the market recently, like most of this build, like this kind of the AI agent is built around native the crypto assets. But this AI agent is not 100% exceeds or feasible for trading the gold or tokenized real world assets on chain. So exactly the asset classes that matter most for emerging market users, like people who dealing with the inflections in currency risks every day. And I think when AI become a real market participant, we will rethink and rebuild the whole market infrastructure itself. Thank you.
Okay, thank you. Sounds great. And let's talk about tokenization and traditional finance moving on trend. According to DTCC's official announcement, DTC have received the SEC approval to provide asset tokenization service, approve the blockchain for DT's participators and their clients. The service is expected to move into the production in the second half of 2026. This is the major sign for the RWA and the external adoption narrative. So my question is, what impact could the DTCC's move on trend have on the crypto market? And for bigger picture perspective, how might the reshape the structure of U.S. financial market and the future relation between traditional finance and the crypto? From Luis Diaz.
Yes,
Luis?
let's continue. Yeah, I heard the question. So the convergence of traditional finance and digital assets has reached a major milestone. DTCC, I guess we need to say that it is Depository Trust and Clearing Corporation. So DTCC recently announced that its asset tokenization service has received SEC approval and is scheduled to enter production during the second half of 2026. The initiative will initially tokenize US Treasury securities, major index ETFs, and constituent equities on pre-approved blockchain networks. This development could reshape markets in two fundamental ways. Number one, for the crypto industry, the ultimate institutional entry. For years, discussions around RWA have largely been driven by crypto-native projects operating on a relatively small scale. DTCC is different. It's totally different. As the world's largest post-trade infrastructure provider, DTCC oversees approximately, think about it, 114 trillion in assets, 140 trillion USD. By using blockchain-based settlement rails to connect traditional financial assets with digital networks, DTCC is creating an unprecedented supply of complete, high-quality yield-bearing assets for Web3. The liquidity gap between TradFi and DeFi could be dramatically reduced. Number two, for traditional finance, the ultimate efficiency upgrade. Through blockchain technology and smart contracts, tokenized assets can enable T+0 settlement, eliminating settlement delays and reducing capital lockup across jurisdictions. More importantly, tokenization significantly enhances coloring mobility. During periods of market stress, financial institutions could potentially move hundreds of millions of dollars in treasury coloring across complement blockchain networks within minutes. This is not merely a crypto industry headline. It represents a fundamental shift in the settlement architecture of global capital markets and signals the arrival of the programmable finance era. Thank you.
Oh, thank you. Well, what's your opinion?
Yeah, thank you for the questions. And I think this question is pretty close to us, and I think there is a very exciting news for DTCC recently, and I actually got to see their booth at Consensus in Miami a month ago. So just to set a stage, the DTCC is the core post-trade infrastructure for US securities markets, and it's custodial around 114 trillions in assets that Louis mentioned before. And basically every stock and bond settlement in the US run through this. So they officially announced their tokenized service roadmap at Consensus a month ago. And the first phase covered the Russell 1000 stocks, major ETF, and US Treasuries. And limited production trades starting July this year. And a full commercial will be launched in October later this year. So this industry, the industry working group has over 50 firms like the BlackRock, Goldman Sachs, JP Morgan, Circle, like that, and NASDAQ, like both traditional finance and crypto native, like all in the same room. So I think it's very exciting news for everyone here, like, because when we saw this information and standing there at a booth, the feeling I got was this is the plumbing of American capital markets gets rewired, and a lot of people are reading this as the Wall Street is accepting blockchain, but I think the more accurate framing is that Wall Street is accepting on-chain market structure. Those are sound similar, but it's a little bit different. The previous one is the technology endorsement, and the other is the structural migration. So if you look closely at it, RWA liquidity that actually existed today, you will notice something interesting, like the tokenized trade, like the tokenized gold and US treasures has real trading depth, but pricing is transparent and the market makers are willing to come in. But most of the other RWA categories, like private credits, the real estate, commodities, so those or secondary markets are still very thin and widespread and almost like no derivatives for hedging. So the insurance layers expanding very fast, but the liquidity coverage across the assets class is deeply uneven. So for me, the most important things about a DTCC is not a simple signal that's a big institution show up show up recently. It's that like it's make a structural problem like more visible. The assets insurance and compliance layer is getting viewed by institution fast, but the liquidity and the trading layers for most assets class is still lagging far behind. And I think the more assets DTCC bring on chain, the more obvious the gap becomes and the more real the demand for the industry, for infrastructure like what we are building gets. Thank you so much for the questions.
Thank you, thank you. It sounds great. With more traditional assets trade on chain. And next, I want to bring up our topic that has been getting a lot of attention. Strategy and this Bitcoin holding. There has been increased discussion around whether strategy could be forced to sell Bitcoin under certain market conditions. At the same time, ETFs, crypto Bitcoin reserve, traditional finance, and crypto native liquidity are becoming more deeply connected. So my question is, how do you view the possibility of strategy being forced to sell Bitcoin? And look ahead, which force do you think will have a greater impact on the crypto market? Institutional ETFs, public company balance sheets, traditional finance, or native crypto liquidity? From Walla, can you give your opinion?
Yes, of course. So for me, I think the short term, I think the probability of a forced liquidation is not that high. The most of their debts is convertible notes and not directly loans. So the conditions would trigger forced selling are stricter than the narrative suggests, and there's still a decent buffer at current price level. But there has a structural things worth paying attention to. What strategy is really doing is turning the public company's balance sheet into a leveraged loan on Bitcoin. So in a bull market, that looks very like clever and smart because, but it's taking the traditional financial leverage risks on top of crypto markets. So once the market start worrying about that, that worry become the fulfilling. And under those three focus that you mentioned before, I think is very hard to compare directly because the ETF are very slow, variable, and the corporate balance sheets are the large single entity exposure and higher fragility, and the actual price discovery happening every hours of every day is still native on-chain liquidity. like exchange, market maker, the defined puts, real buy and sell flows. So the ETF and corporate holdings are grow really fast, but native on-chain liquidity depth hasn't kept on the pace. It will be like getting amplified in an extreme move. That's my take, and I will pass to the Louis.
Okay. Lois, can you add something?
Yes, I have an answer. Thank you, Vera, for your answer. And my opinion is that as Bitcoin continues to trade in volatile range, fears have emerged that MicroStrategy could be forced to liquidate its holdings and trigger a market collapse. In my view, this is entirely a false narrative. A close examination of the company's balance sheet reveals that its convertible notes and preferred share financing structures contain no mandatory liquidation thresholds. As long as interest obligations are met, even a substantial decline in Bitcoin's price would not force the company to sell its holdings. Furthermore, its net leverage ratio is only around 11%, and it maintains a healthy liquidity position. So, it's false narrative, as I already said. The widely discussed death spiral scenario is largely a product of market psychology rather than financial reality. However, this debate highlights the three major liquidity forces currently shaping the crypto market. Let me focus on these three forces. So, number one is spot Bitcoin ETFs, the ultimate source of new capital. Spot ETFs from institutions such as BlackRock and Fidelity connect Bitcoin to long-term, low-leverage capital from traditional financial markets. These flows increasingly determine Bitcoin's long-term floor price and make the 80% drawdowns of previous cycles less likely. Number two, public companies holding Bitcoin, sentiment indicators and volatility amplifiers. Companies like MicroStrategy can amplify bullish momentum during strong markets. However, during uncertain periods, even minor concerns regarding their financial position can trigger exaggerated market reactions. And number three, native crypto liquidity, the on-chain reservoir. Low gas fees and the persistent weakness of many altcoins are signs that native crypto liquidity remains constrained. This liquidity pool unlimitedly determines whether a broad altcoin recovery can emerge. So the key takeaway, number one, institution ETF flows determine Bitcoin's long-term trajectory. Number two, corporate balance sheets amplify market volatility. Number three, native crypto liquidity determines the strength of the broader altcoin system. Thank you for your question. It is a very important task. So I'm happy that we can discuss it.
Okay, thank you. Now let's move the final major topic. If global liquidity begins to expand again in the second half of 2026, investors will be looking for the next major opportunity. We have several strong narratives in the market: US AI stocks, gold, Bitcoin, stablecoin, RWA, and AI plus crypto. So my final question is, where do we see the biggest investment opportunity in the second half of 2026? And And if you have to choose one sector with the best chance of producing the next 10 times opportunity, which one would it be and why? Begin with Luis.
Yes, okay. So you mean which sector has the best chance of producing? Yeah, okay. If global liquidity begins expanding again due to regional or macroeconomic catalysts, which sectors are most likely to generate 10x? I would say that okay, let's eliminate the obvious candidates first, okay? Gold and stable coins, excellent defensive assets. Gold may continue making new all-time highs, but neither offers the exclusive upside necessary for 10 times return. Next one is AI, major caps, and Bitcoin. So these are the foundational beta assets of the current cycle. However, with market capitalizations already measured in trillions of dollars, we already talked about this today, right? Achieving a 10x increase within a short period is mathematically unrealistic, okay? They are best viewed as portfolio anchors. So it's not about 10x increase. The real 10x opportunities. Most explosive upside is likely to emerge from high growth sectors benefiting from powerful structural catalysts. And two sectors stand out, right? RWA, real world asset tokenization. As DTCC launches institution grade tokenization infrastructure, the sector could experience unprecedented regulatory and institutional tailwinds. Protocols that serve as compliant bridges between traditional finance and blockchain networks, along with the decentralized compliance and Oracle infrastructure providers, currently have market capitalizations ranging from hundreds of millions to a few $billions. Yeah, that's not much comparing. These projects are best positioned for significant valuation expansion as institutional capital enters the space. And number two, AI plus crypto, decentralized AI. Right, this sector combines two transformative forces. Number one is AI's revolution in productivity. Number two is crypto's revolution in ownership and coordination. We call it DPIN, decentralized physical infrastructure networks. So DPIN aim to challenge centralized computing monopolies, while blockchain technology can help address data ownership, model verification, privacy, and incentive arrangement. These innovations create a compelling framework from the next generation of digital infrastructure. So the final strategy is defend the core, pursue the extraordinary. Extraordinary. My recommendation for the second half of 2026 is balanced approach. Use AI leaders in the US, equity market, and Bitcoin as the foundation of your portfolio. That's number one. Number two, allocate approximately 10 to 20% of high-risk capital to leading RWA infrastructure projects and DP networks. This approach seeks to protect downside risk while maintaining exposure to the most significant technological and financial transformations of the coming decade. I hope that I fully answered your question, and thank you. Okay, thank you for listening to me.
Okay, thank you. What's your opinion?
Yeah, so for me, I think the most interesting opportunity in the second half of 2026 isn't like in any particular assets. It will be on-chain trading infrastructure later. So here is the reasoning that if global liquidity expands again, like the Bitcoin, the AI stock, commodity, they're all benefits. And I think there is no argument on that. But the beta on this assets is already pretty high. And the volatility is compressing and getting to like 10x required massive capital inflows over a long time. But if we looked at the other side, the RW market that Louis mentioned before as well, the real assets on chain just cross 30 billions in the total volume and up 30% in a single quarter. So BCG and a Standard Chartered project, it could be reached to the 16 trillion by 2030. So the assets insurance layers is getting built very fast. And with the DDCC going live in July and full launch in October, and more institutional assets completing the tokenizations, I think the demand for on-chain trading infrastructure is going to from discussed to urgently needed in a market. And as I mentioned before, like most RWA categories are very fragile, in the they are very wide spread and almost no derivatives. So there has a one thing's worth to notice that CME just reported the record quarter first on 2026 revenue of the almost 2 billion with 66% operating margins. So they don't take any like market risks. They just provide the platforms. But interestingly, the CME and NYSE are already pushing the regulators to the on-chain platforms that many DEX currently, which tell everyone they already see this a real competitive threat. And the on-chain version of that infrastructure layer is being built. So I think that's a very good direction and as stable we are building with this infrastructure as well. And we're starting from the precious metals like gold, silver, and FX. So where the global pricing is very transparent, and the standardization is high, and hedging demand is strongest. So with the thousands of active traders across many countries in Asia and South America, and the part of what making us different is who we are building for, that we are building for the traditional finance trader in the emerging markets who need the professional grade tools, and we provide up to 500x leverage on the precious metals and 1000x leverage on FX. And I think that combination doesn't exist anywhere else on chain right now. So yeah, the RWA market on chain is a very worth point to pay attention to. Yeah, that's my opinion, and thank you so much for that.
Thank you. Wonderful answer. Thank you for your participation, Luis and Wella. And before we move to closing thoughts, a quick reminder for everyone watching. Today's live stream included our job. Make sure you stay alive. Activity in the chat for the instruction for our team. And don't leave earlier. We will be selecting illegal participation based on live stream rules. Also, feel free to drop your question in the chat. We will pick a few audience questions for our guests if time allows. To wrap, I will ask each guest one quick final in one sentence. What's your key market outlook for the second half of 2026? Is it bullish or cautious or selective?
So
Yeah, Lois.
yeah, I will
Select
answer.
one
sentence.
one sentence.
Yeah, one sentence.
Bullish
I
or
already,
cautious or selective?
yeah, that was my recommendation for, as you asked, for the second half of 2026.
Yeah.
Defend the core, pursue the extraordinary.
Yeah.
Yeah, there's one sentence.
One sentence. There, one word. Bullish, cautious, or selective.
Once again.
Word. Choose one word for your key market outlook for the second half of 2026. Which word do you think is bullish, cautious, or selective? Three words. Which word?
Selective.
Oh, selective. Oh, thank you. Voila, what's your opinion?
I will do the selective as well.
Yeah. Oh, okay. Thank you very much. And thank you to all our guests for your sharing your insight today. And thank you to everyone who joined us live. Don't forget to follow HTX for our market and discussion, live session, traditional insight, and upcoming Capricorn. And make sure you check the live stream chat and official announcement for our job details. Thank you all for today's session. I'm Luis, and I will see you next time on HT Time Live. Thank you all, and
Thank you, Lewis. Thank you.
Thank you so much. Thank you.
See you next time.
See you next time. That was a
Yeah, see
great
you next
discussion.
time.
Yeah.
Thank you so much.
Thank you.